Welcome to Markets Now. I'm Michelle Rourke with John Payne with Advanced Trading, and we did have mixed markets in both grain and livestock futures today. Let's break this down. First of all, John, soybeans managed to end higher. We held contract lows. Were we just putting weather premium in, or was there more going on?
I think it's part of it. I mean, the weather certainly it's hot, but it is August still, and I don't want to bury summer yet. I think the more likelihood here is you just have buyers that are interested in locking in margin. Crush margin is really good. The Chinese are buyers now at this time of the year, so you're not going to see that story disappoint too much. Although I think the overall numbers aren't where we want them to be, but there is buying there. And then you don't have the carry-in that you have in wheat and corn. And by carry-in, meaning the supplies left over from last summer that were harvested. So the beans don't have that. I mean, we have a very tight bean crop here. In fact, with September is this low below the January, it really makes sense to want to come in and buy here if you can store them. You're getting the 40-cent discount. So I think the market's going to have a tough time rallying until we get them out the field. Beans are going to move here. I think a lot of folks, tend to want to move beans early. But looking at that Jan contract below $10, I wonder if we can stay down too long here. Once we get beyond first notice day and you have the meal markets and the soybean oil markets that continue to stay upwards of 40 cents and 300, that I think those crush margins will be enough to keep the beans at least sideways.
No flash sales on soybeans today, but we had a nice string last week. Do you think we can get caught up on soybean exports? So we are behind quite a bit.
No, I don't think so. I mean, but that number can be played with so much just due to rolling forward and rolling backward of contracts that I don't tend to want to focus too much on what the Chinese are doing. One, it's so hard to predict that it's not a whole lot of fruitfulness that comes from it. I just think given how cheap we are and cheap relative to everything else, I mean, the last time we traded at $9 beans, oil was at 40. So oil up here at 80 now, provides a lot of a better price point. In the case of soybean oil, we're 40-cent bean oil. When we were sub $8 a while back, we were closer to 20 cents in the bean oil contract. So at this point, the margins are there. We just need to get volumes up. And I think that's where fiscal policy comes in. I know this isn't going to probably happen over the next 6 months with the election happening, but I would think over the next year, things will change a little bit. Something will, and it always does. If I knew what it was, I would tell you. I'm not hiding it. I just don't know, and you got to be ready for it. I think upside volatility is probably something folks should be looking at. I don't know how short-term you want to be with it. I think longer-dated stuff makes sense, and with that carry, that's hard. But at this point, that might be the play, just given that when it snaps, it'll snap, and whatever makes it happen, that'll be the driver. We won't be able to predict it.
Corn, new contract lows, both old and new crop today. You think that was mostly first notice day selling, though?
I do. I think that you just have a lot of supply that needs to be traded. Just anecdotally here, Michelle, the conversation I have over and over again is I have a lot of supply. What do I do with it? And it's not just in new crop, in corn. It's in old crop as well. So you have just kind of the flush it trade, get rid of it. I'm done with it. And that in reality is the certainty trade. The certainty trade is going to bring about the most cheap price you can find. If you're going to wait until you have it, it's probably going to be cheaper in this market. If you're going to go out on a limb and sell it before you have it, you're going to get rewarded. And that's the carry trade here. So if you're willing to put it in a bin, I mean, you can put it in a bin and trade off March and you're going to get, I mean, we're up here at 35 higher. In the case of beans, you're almost 60 higher. So, just because you store it doesn't mean you should speculate on it and the market's going to go higher. The market is higher now in those months. And I think worst case scenario for folks is the market goes nowhere. It's that the volatility upside buyers don't make any money from their upside bets and calls, and the market stays sideways where the carry just kind of slowly marches lower every single delivery period. So I think in the near term, I think we'll make another run at $4 sometime in the December contract. I think we'll see $6 in the Minneapolis. The question is going to be, does it stay there, and how close to delivery when those folks want to not pay for contracts. But I think the market will get cheap enough here where folks are going to say, I'm not selling it. The storage play makes sense. We're just obviously not there yet, or at least we weren't this morning.
Yeah. So new contract lows in the wheat market. And again, if that was first notice days selling, once we get that out of the way, can that market start to rebound?
I think so. I mean, I'm certainly not going to be able to time it as well. I've been telling you to buy. I'm probably long already. I just think you look at the play from 2020 when the market was inundated with supply. It bottomed the day of delivery, first notice day, August 31. So at this point, I think the market will trade better. I think a lot of those forced sellers, and by forced sellers, I mean elevator manager calls you and says, hey, you've got supply. What are you doing with it? Do you want to pay me money to hold it for you, or do you want to sell it today? That's a tough decision, and it tends to price itself in at this time of the year. So in the case of the spring wheat, again, very anecdotal, but folks I work with up in the Dakotas, they're doing 100 bushels an acre. I mean, they're doing double what they would have done in an average year in some cases. So all of that supply, it doesn't have a home. It's just got to go. And that means liquidation sales to a degree. Once that dries out, and I imagine it will here as folks start to get looking at other crops, I think it'll trade a little better. I think Minneapolis, in a way, will find a protein premium again. And right now, that if you want to play a trade, that would be one to look at, would be the protein play where, Chicago is trading 40 under the Minneapolis. I mean, that is, I don't know if we've seen that in a long time, outside of when the markets were at $11 and Chicago wheat was being bid up. So I would imagine you'll see, like I said, the market will flush. You'll see everybody make that decision, price a roll, and then the storage will go up. You'll see the protein premiums come back in, and I think that should help the KC and the Minneapolis a little better.
Yeah. Nice update in the cattle, John, considering I think a lot of folks thought we were going to be lower after the bearish placements number in the cattle on feed. Why were we able to shake it off? Are we trying to bottom?
Margins are good. At this point, we can get all bearish on supply, and that, I just think two things. One, you have $300 beef. And that's important to remember. Like if you have $300 beef, you're going to see, buyers come in to try to lock in that margin. The second thing is, the LRP has made it very difficult for the market to get too cheap too quick anymore. There's just so much insurance out there on the market in the case of the producer side. So that's one of those things I kind of pay attention to, and how much buying is going on with LRP. And in a way, it's like kind of a crop insurance trade to a degree, where the market will never get cheap enough to want to pay out because it takes sellers to do that. And those folks are insured already. So at this point in time, I don't think you're going to see these big supply shocks from the USDA change the market. I think it's got to come from the physical side. And that can come from like a meat packing plant going out of business, or, the beef price suddenly falling out of bed. But we had durable goods orders this morning. I mean, the U.S. economy is still pretty good. And, we're talking rate cuts, but I think, in my opinion, the risks really skew towards the economy staying hotter than they would like it to, so they can cut rates. And if that happens, maybe then you do get that washout like we saw 3 Mondays ago when the Chinese or the Japanese markets were melting down. Maybe that's what it takes from. But the U.S. economy here, just from a data standpoint, looks okay. It's right. Certainly hanging in to keep prices up on the beef side. Right.
Let's close with hogs. Obviously, we had a chart breakout last week and had a higher weekly close. Is that due to the discount the futures are holding to the index, or what prompted it?
Yeah, I think that's part of it. I think that you have this huge spread between, let's call it, these futures, which are trading in the mid to low 60s, and then you had the cutout trading upwards of 100. That's just a massive spread. Even with the deferred cutouts where it was still a $20 wide spread between where the futures were priced. That's a very good margin. Again, you have the box beef, the finished product trading up here, and the input price down here. It's like that margin is there to be locked in. Second thing is you have the Chinese hog markets have really bottomed, and that would be one I would watch here. It's a follower. The U.S. seems to want to follow that market in pork. And then lastly, we have $300 beef. You have poultry prices that are up. Like, pork is cheap. If I was running the show at pork, I'd figure out a way to sell it, because it certainly pencils at the grocery store. Very little does in the meat counter right now, but pork does. I mean, I bought 2 big pounds of pork chops yesterday for $7. I can't buy a thing of hamburger for $7. So at this point, I think that's where pork has its upside to it. Plus the Mexican economy, who are big importers of ours, they're doing well. So at this point, inflation is our friend overseas, and they'll buy pork if they can get it.
Yeah, and we got evidence of that certainly in the monthly cold storage report, what you just said. So, all right, thanks, John. John Payne with Advanced Trading. That is Markets Now.